Hello, and welcome to Solano Home Assist, our free tax workshop today with the wonderful Karina Cook. Today, we are going to be talking all about ways to maximize your deductions, to navigate the complexities of tax filing, and so much more. So, this workshop today is brought to you by Solano Home Assist, and we are funded and honored to be partnered with Solano County. Solano County is deeply invested in making sure that people are able to get home and stay home. That has been the motto of Solano Home Assist from our very first day. And if you're unfamiliar with what Solano Home Assist does, we provide free one-on-one counseling around housing, eviction prevention, foreclosure prevention, credit repair, and information for folks who are interested in purchasing their own home. You may not be ready today, but we can help work with you to identify the skills and habits you need to do now so that you can be ready when you want to go down that road. You can find all of this at our website at solanohomeassist.com. That being said, I'm going to switch gears and I want to introduce you to somebody who has just blown me away. I'm going to bring on Karina Cook. She is a CEO and expert tax strategist. She is a woman of God, a devoted wife, and a mother. Her passion lies in empowering individuals, business owners, and families to take control of their financial futures. So it is an honor to bring on Karina. Let me find my button right here. And my whole system seems to have completely frozen, so I am having some problems right now. Give me 1 second here. Yep. I am unable to hit any buttons right now. This is absolutely awful. I'm so sorry. Everybody is watching right now because clearly you guys are watching me sit here and fumble with how to get this up and running, and my Chrome has completely bombed on me. So that being said,
right. You hear me?
I can hear you just fine. I'm gonna have to do something. Yeah, I've got nothing. I am so sorry. I'm going to pause the stream for 1 second and we will be right back. Won't even let me do that. Oh my goodness. I can't get into the window. I can't click anything. Oh my gosh, for all of our viewers, I am so sorry. This is absolutely awful. I don't even know how to get out of this short of just completely tanking my computer. And so I can't even pause the stream or anything. Give me 1 second and I'm gonna get this fixed. So Karina, the folks at home, they can't see you, but they can hear you. If you would like to, while I'm struggling, maybe give an introduction, introduce yourself, how you got into taxes, and that would be great.
Okay. So, hi, everyone. My name is Karina Cook. I am a tax strategist, as Nisi said, and I own a couple of businesses. What my passion really is, and I hope that you guys can also see that today, is really to empower people in general. So, even though my focus is usually like business owners and things like that, my passion is that person behind the business, the actual person itself. So I try to lead by that with giving people enough information, maybe not trying to fully overload you with things that may be overwhelming, but try to make it simple as possible so that ultimately you can be prepared. You can also understand what kind of wealth you can bring to your family members. And classes like this, I think, is really important because sometimes you hear a lot on the internet, or you hear a lot of discussion from many other folks, and it's good to have online. It's good to have a source where you're saying, okay, well, what is it coming from you? If I can understand what you're saying, can break it down, please explain it. And so I hope today, as we're talking about how to prepare and what you guys can kind of equip yourself with this year, that you kind of keep that in mind, is that the ultimate goal is to empower you guys so that you can leave with some type of knowledge you can also pass along to your family members, sphere of influence, and people around you. So, the goal is to also in this workshop make it where, you guys can talk in the chat as far as like if you have any questions. And, I'll try to make this as interactive as possible during this session. I will do my best with not just talking with you guys, but more so keeping you guys in the loop with things that are happening, because I love to hear your experiences and see from your lens like what you've actually done or gone through, or situations that you feel relates to the topic that we're discussing. So one of the things I will say is, you guys know we're already in the mid of tax season. So I hope you guys still have your hair. I hope you guys are still being positive through it. We're kind of reaching a peak of 1 month through the heavy part, right? And then everything else will feel a lot less strenuous on you guys. So.
Hi, Karina. I am back. I apologize for that. For some reason, your camera is dark to me. I don't know if that's just something on my end, since obviously my computer does not want to work right now.
Okay.
So I don't know what is actually happening here.
Okay, 1 second. Let me figure
It
out.
may just be me and not you.
Can you see the chat? Like if you share the screen, can you see the chat to see it?
I am seeing nothing at the moment. This has been, oh, there you are. I see you there. Looks like you're coming.
So you can see it?
Yes.
Okay. Can others see it? Maybe can you, if you guys can see my screen, can you guys type 1 in the chat? If you cannot see it, type 2 in the chat so we can see if you guys are able to see me also.
I'm going to go. So for the folks who are watching us right now, you might be watching us through Facebook or Instagram. We also have a broadcast page on our website, and that is at solanohomeassist.com. And this is being broadcast at Get Ready for Tax Time. So that is an alternate viewing location. And it is also where Karina has prepared an amazing tax checklist for you. And it is available to you on that site. So if you are joining us through another location, I would recommend come and visit us in the come and visit us at our website. Or you can continue to enjoy our presentation on Facebook or Instagram. I see we've got one person in the chat, Jess. Hi, Jess. Nice to see you. So, Jess, if you can right now, are you able to see Karina's camera at the moment? If this could just, so for those who are watching, behind the scenes, I'm sort of the nerd here in the company, and it's really embarrassing that right in the middle of doing this, my computer decides to freeze. I had to basically shut the whole thing down and come back, and oh goodness, so I don't trust any of my setup right now. So that being said, I don't want to hold us up. So I'm going to go ahead and Karina, did you want me to start sharing your screen at this point?
Sure.
Are you ready to go through that? Okay, let's
share my screen, and it's okay if they can't see me. At least they can see the content.
Okay, so fantastic. And I'm going to get my.
Okay, Nisi, give me the clear when it's on my end, if you can. Okay. So first and foremost, guys, I want to thank you for being in this live stream with us and being able to put yourself first and be here. So one of the things, or what we're going to focus on mainly during this process, is to understand how to make this time simple, and what are some things that you can focus on while we're in this season. And this season, I mean today and up until April, but beyond, because I truly believe, and professionals in our industry, in the finance world, especially tax, it is important to know that tax season is not just right now between January and April. It's all throughout the year. I like to think of it as, hey, you're getting taxed on your goods, you're getting taxed on sales tax. Anywhere we go, we are taxed, and that is not during January and April. This is actually during the entire year. So some of these things you can take with you, keep in mind during the process of going throughout the time of knowing I'm going to be taxed, and this is something I can work on or keep in mind during the time. So what we'll cover today is really how to what's some changes going on in 2025. What are some tax credits and deductions that you guys can look out for? How to prepare and keep your documents together, like what is important in that area. And then when it's time for you to start giving up your tax prep or preparing time to a professional, and like what does that consist of? So if you guys have any questions, you can throw them in the chat, and then Nisi will be helping me answer some of those like questions, and so she'll bring those up as we are going through this presentation or this workshop. So without further ado, let's go in. So you guys, there are so many ways we're taxed. And as you guys know, I put 4 things up here, okay? There are like over 10 different ways we are taxed. And it's honestly hard to keep up with. Some of them are out of sight, out of mind. We are so used to paying tax that it becomes a normal thing as far as us not thinking about it. And so what I love to do is say, okay, well, the ones that we really have control over, how do we focus on those things?
Hey,
and
Karina,
so, yes.
I'm so sorry to interrupt you. It is still showing the title of your presentation.
Oh no.
Not this.
Okay.
I think you wanted us to go second slide, because I want to see all the ways that I am taxed, please.
Okay, let me figure this out.
You just click on your second. Oh, you had it. You just had to your second slide in PowerPoint. Not a problem.
Yeah.
And
Okay.
the next time we do this, because clearly we are today we are dealing with a comedy of errors. So when we do this again, we're gonna have this so figured out.
Thank you guys for staying with us. 1 second, let me just share my screen so that you can see.
And while she's doing that, I do want to say, so for those who are watching and listening, if you are struggling with figuring out how you're going to pay your rent, you're facing eviction, you would like to know what you need to do to clean up your credit, you would like some information on how to better prepare for taxes next year, please go to our website, solanohomeassist.com/start. And once you're there, you will fill out a little form. And matter of fact, while she's being on that, what I'm going to do is I'm going to bring up that screen right now, and I'm going to show you just how simple it is. Let's see. So I'm going to present. I'm going to share a screen. I'm going to share this guy here, and there we go. So this is the Solano Home Assist website, and scrolling through here, you can see all different services that we offer. But what I'm going to point you out to right now are 2 things. One, on our workshops tab, this is where you're going to find out about all the different workshops that we have coming up. So right now we're going through getting ready for tax time. And later tonight, Cortez is going to be walking us through your path to home ownership. that's something that you're thinking about and are ready to start figuring out what you need to get ready, that's another free workshop that's happening tonight. Clicking the start button right here, this will take you to our intake form where you simply fill out some basic information about yourself and about the issues and challenges that you are struggling with. And at that point, you will get to schedule your free one-on-one session with a counselor to deal with your specific challenges. And the coolest thing about this is, as you can see from my screen right here, you can see all the dates that are available, and you pick a time that works for you. There are so many times available, so you are not alone out there, and you do not need to struggle. So that being said, it looks like Karina, it looks like you are ready to go.
Yes.
So I'm going to, I sure can, and that actually looks beautiful. And so
Perfect.
I'm going to take myself off and take it away. Thank you.
Yes, you're welcome. You guys, thank you so much for your patience. So what I was saying is there are so many different ways that we were taxed. And the thing you can really take from this is, what can I actually control, right? So we have these 4 things that I thought was really important to show you guys is the federal income tax level, and how we're taxed on our earnings. So when we make income from our W-2 income to our stocks to our maybe we're self-employed, any income that you're getting is going to be federally taxed, okay? And from this, it's going to be paid to the IRS, and they do whatever they do with it to help support our government in many different ways, okay? We also have state tax that we pay, and I think some people also forget that you have state tax, and sometimes even if you're not filing prior year returns, some people think IRS, but they don't say state. So I encourage people to remember that there is state income tax, and state sometimes can be a little more harsh than the IRS. And we see many cases where they don't play when it comes to their money. So that is one of the things that you can look out for, which still they take a portion of your earnings as well. Then we have property tax. So those of you who know, by having a home, you pay taxes on your real estate property, okay? And some of you who are able to itemize, you use this property tax on your taxes, right? If you are able to use that as a tool. And then you have sales tax, and that's something I mentioned where, you know, we're going out and we're being taxed on things, and businesses have sales tax and things like that. So all that is paid back to the state. And so those are some things that you want to like say, okay, what can I do when it comes to federal tax? How can I lower my tax liability? And when you're lowering your federal tax liability, that a lot of times works as well for state. Not all things that federal do, you know, federally, what they have in place doesn't always work for states, because states can choose to go a different way than the federal tax is. So there's things like maybe you guys have health savings accounts already, which we'll talk about a little bit. The way that it's reported is not the same as federally. So that's why I say when we talk about the states being able to choose what they're going to tax us on. Okay. Now, this is documentation is really important. If you guys ever heard me speak publicly, then you guys know that I am always talking about documentation. And this is one of the things people get really frustrated over. You guys, I want to know what you guys think. So when it comes to being organized with your documents, what systems are you using? Do you do the paper method where you have like your file system and folders? Are you saving everything online? Or are you like, listen, I'm still trying to hang my head up and get around even keeping up with documents? Let me know in the chat, okay? Because I'm interested in knowing what you guys do in this area. One of the things I would say is when we're talking about W-2s, right? Your employer usually will send this by the 31st of January. So if you guys haven't had a W-2 yet, you haven't received this from employer, I would certainly ask them. Not only ask them, if you do not get a response, then this is the time to now either look to see if there is it's already been reported to the IRS. There's steps you should be taking to make sure that you've already had this. Maybe you can go down and download this. If you're a digital person like I am, I try to save paper as much as possible, guys. I will usually grab this from online in an e-statement, put it into Word, or I love Google Drive. That's free. So you can create little folders. Essentially, it's the same thing that you would do with a filing system if you had like a physical folder. You can get very creative and do subcategories. But if you have your W-2, 1099s, I usually have like an income statement. Like anything with income, I just put it in this file. Anything with expenses, I will put it in a certain way so that I have easy access to it in 2022, 2023, 2024, so that it's easily accessed. Why do I say do this? Well, one, we have a statute of limitations. For us as professionals, it's about 7 years, and we want to keep some of these documents. And sometimes I will tell people, like, if you don't know, keep it, okay? Because in case of an audit, this is why you want to have it organized. It's not just for present, right? If you guys have ever been audited before, let us know in the chat. I'm interested in knowing if that is something that you've been through, because what tends to happen is if you filed your tax return now, and 2 or 3 years from now, the IRS says, hey, maybe you're not in trouble. Maybe they just want to verify something. Can you give me that income statement, the 1099 that you reported on your 2024 tax return, even though it's 2026? You're going to be like, oh my goodness.
So
what did I do?
We do have some comments in the chat. So John D, he says that his stuff's just all in his email until he needs it. Jess says that she's still trying to keep up, that she's in the process of organizing and seeing what she needs to print from online. Vivian, she says it's all in boxes that aren't organized. And then she had a question of how long she has to keep it, but you just answered that. So yes. I have a question of at what point can you stop worrying about audit? If it's been a couple of years, do you think you're in the clear, or is there sort of like a best practice to know, okay, I think I'm going to be all right?
Yeah, that's a good question, Easy. So typically we say 3 years, right? But I've seen the IRS go further than that. Sometimes they'll go 6, 7 years. If you feel like, and the reason why they may do that is because if there was something that was significantly understated, okay? And so we start to get in the talks of like, was something very improper that was documented, right? That is like I literally just had this situation happen with a client where they got audited and it was like 6 years down the line. And they're like, what am I doing? I talked about this publicly. There was a celebrity who had recently, I think this was back in 2013, you guys. 13. Okay. That was over 10 years ago. That he had a outstanding debt with the IRS. And I'm telling you, like, it was hefty. We're talking about $1 million. Okay. And so when you look at it to that point, if it's worth them chasing, then they don't care on how long they can come back. Right. So it's not essentially like your credit. It can be in certain situations. Like, for example, let's say 3 years, right? We say 3 years is a typical, okay, if you're owed a refund, you have about 3 years to receive that refund. At the 3rd year, the IRS is like, we're not going to give you anything after 3 years. So if you file in the 4th year, then you just file and there's no refund due to you. Okay. Even though you're required to file. If you file the 4th year and you owe, or you don't file the 4th year and you owe taxes, they're definitely going to come to you, right? Let's say the opposite is, well, I filed my tax return and it's 5 years. Will they still come knocking? Well, that answer is it depends on what they're knocking for. Okay.
And John asked that question, like, what are the red flags?
Well, red flags is overstating income, right? Or understating income. So some people may, let's say that you've made 100,000, and a lot of times also this can be like self-employed individuals, right? Because sometimes there's not a check and balance, because like a W-2 or 1099, those are reported. So if you work with me or I have an employee, I'm sending this W-2 to the IRS and I'm also sending it to you. So there's a check and balance. With some business owners, they're relying on banks or statements from their income statement. So that is like what their records are. It's just what they're giving the IRS a lot of the times. So sometimes it can be income. It can be numbers transposed. It can be fraudulent things happening on the tax return. It can be something was filed improperly. So let's say a document wasn't properly filed. Things like that are red flags. And also, I tell my clients a lot of times is, if I can see it when I'm interviewing you and we're talking about your taxes, or you give me statements or documents and it's questionable to me, it's going to be questionable to the IRS. So if we're writing off things that doesn't make sense, or it requires me to uncover a lot, that's when it's like, what is going on here? I need to ask a little bit more questions to you, because if I send this tax return to the IRS, that's definitely they're going to wonder why as well. To give you guys an example of that, for example, let's say that some people have not only W-2, maybe they do like Uber, right? They're doing Uber on the side and they're filing their 1099s that Uber gave them. They're reporting that income just fine. But let's say they say, okay, well, I had expenses. And these expenses, they're overstated, meaning technically they've only spent like $1,000 in expenses, but they're stating that they spent $3,000. Well, depending on how that is documented, it will become a red flag, especially if it's not a standard industry specific, where we know that type of industry doesn't bring in that type of work. And if it does, then you need to have documentation. So those things are like really things I would look at. And I may have a slide here too that may cover, I think, a little bit more, but does that answer your question?
Yes, thank you. And for those there, we will make all these slides available to you after the class so that you can go back and refer to them.
Okay. Now, maximizing on your deductions is really, I think that's what we're all here for. How can I lower my tax bill? Okay, if I owe taxes, I don't want to pay. And that's just real. Okay. And I'm here with you guys. So a couple of things are important to note is using these things. These things can be used if you're itemizing. So for example, we have the head of household, which is right now $22,500. That's it's a good amount. Okay, I can sit with that. If you're married, it's about up to it's to 30,000 this year, and then single is 15,000. Single, you guys are doing good, because before I think it was 14,600, which is still okay. But let's say your medical expenses, home mortgage interest, you donated to charity, you had property tax, you have student loan interest, and this exceeds. So if I'm single and my standard deduction is $15,000, but all of these expenses I got actually $27,000 worth because maybe something, unfortunately happened where I had to come out of pocket with my medical expenses and that boosted it. Well, then it's going to be beneficial for you to use that $27,000 because the IRS is only allowing you to take a $15,000 deduction. So, medical expenses is really important for you to make sure that you're kind of keeping aware of, because I know a lot of people will come out of pocket for their expenses. So this is important. Mortgage interest. So if you guys own a property, and also don't forget the property tax, that if it exceeds the standard deduction, this is when you use it. Sometimes I get clients who the standard deduction is just high for them. And they may hit, they may have their mortgage interest, but it's just not enough to overpower what the current deduction is. We just won't use it, right? Because it's better to go with what's higher. Charitable donations. Does anyone give to charities? Let us know in the chat, because this is something that I feel a lot of people miss. So if you're an avid giver, maybe you give to a nonprofit, a local nonprofit in your area, or a church of your choice. Those things are, of course, it does have to, it's not going to be as beneficial on the tax side if you're not itemizing. But if you're doing this throughout the year and your mortgage interest is also really high during the year, then go ahead and take it. If you have student loan interest, you're going to school, or you have kids, there's things that you can do to like maximize on that. Deductions is what we really like to do, because you want to ultimately get yourself in a lower tax bracket, right? So we don't, instead of being in 24%, which 24% right now is, let's just say for single. Okay. I don't know if you guys, like who's in the workshop, I don't know your filing status, but let's just say single is 24%, right? And right now that goes, if you make $103,000 up to $197,000. Okay. If you fit that range, then they're going to tax that about 24%, a portion of that. Okay. Would you rather be in the 24% or be taxed in the 22%, or even 12% if you're lucky? So that is why these are really important, because you want to essentially show that you're in a lower tax bracket so you can be taxed less. Okay.
And so a couple people in the chat, somebody, Vivian, wrote that she just does like Goodwill donations, and Jess says that she does contribute to charity.
Okay. Yeah, keep those receipts, guys. Keep them, because you can use that if it's advantageous, right? It has to make sense for this. And there's a portion that, and also I think right now it's up to $300. So you can write off or get a $300 deduction, but anything counts. But let's say that you do $1,000 or $1,200, that whole thing, you won't get a deduction on that. And ultimately it just lowers you into a different tax bracket. So, the more you give, the better. But I appreciate all those charitable givers out there. I love that. And don't forget, because I think people also forget that when you're donating clothes to charity, right? You keep those receipts over a certain amount. I don't have that actual amount on the top of my head, but there is a set amount that I want to say, if it's over $4,900 or $5,000 worth, if that's the fair market value, the higher that you get is better for you. Because now, let's say I donated throughout the year because I just cleaned out my garage, and I said, I'm dropping all this stuff off at the Goodwill. You should be documenting that, right? Don't just take it and give it to them and let them give you a receipt. I would keep, okay, what did I give away? And how much, because that can be very beneficial come tax time, is what a lot of people don't know, is what's the fair market value of it today? Because it may have decreased, right? It may not be the same value, but they would take a t-shirt and say, well, that t-shirt probably was $30 when you first bought it, but maybe it's $10 now. Okay. So that is like something, and they have standards that they go by. You can go on the Goodwill website. You can go on a lot of like, Salvation Army may also have that list of items of what they deem is the fair market value. And then you would go by that. And then that can actually go on your tax return. So I would pay attention to like what you're giving throughout the year.
Thank you.
Of course. So now you guys, we have child tax credits, okay? Or not even just child tax credits, we have credits. I like credits. And can you guys tell me, does anyone currently maximize all the credits they feel they can? And do you guys know the difference between the credit and the deduction? Because if you don't, then I'll go in and explain it. But if most of you kind of already know, then we can skip that. So let us know if you know what the difference is between credit and deduction. Put a 1 in the chat, and 2 if you want me to go a little in more detail. But right now we have these credits, which are the same as what we had last year. But if you have a child, that credit is an additional $1,700. Okay. We have the earned income credit. So with the earned income credit, this helps when so there's like a low to moderate size income that fits you into this earned income credit. So if you're over the limit, then you phase out of it, and some may not qualify for this credit. And if you're too low, then you might not get the credit. Okay. What also helps is if you have children, this helps boost up that credit more. And then right now, we have 632 from the start of it up to 700 or 7,830. So that's a really great credit if you're striving to like, okay, well, maybe I fit in this bracket. I can actually get this. And these you guys are for 2025 numbers, not currently. I'm giving you what you should be looking at for this year, and then flowing into when your taxes are filed next year, what you can look out for. Okay. Then we have the child dependent care credit. And so if you guys take your kids to childcare, so this doesn't qualify if you're doing like tuition. Okay. So if you're paying tuition for maybe your third grader or something like that for the dependent care credit, that doesn't really qualify here. Like if they're going to school and you have to pay for that. This is like usually child care. Okay. And so that credit is really good. And, I used to use this credit a lot for my kids when I first started having children. And it was very helpful to get. The thing I love about credits is that you get, and this is why I was asking if you guys knew the difference between the two, because let's say that right now you owe $10,000 to the IRS. Okay. That deduction from all the things we said itemized took you down to not owing anything. Now you're like, cool, I don't owe anything, but I owed $8,000, but I had a $10,000 deduction. Well, that extra $2,000, the IRS says, well, we're not giving you any money back for it. We just deduct that $8,000 and you don't owe any, right? On the flip side, with the credit, it's a dollar for dollar. So if you're in the same situation, you owe $8,000, right? But you have a $10,000 credit, you're going to get $2,000 back. Okay. So even though you owed $8,000, you're like, sweet, I got an extra $2,000 because it's a credit. They give you dollar for dollar. So that is the thing where you try to figure out what credits are out there for you, because then if you don't owe anything, they'll still give you money, if that makes sense.
So
Um,
going to the comments. So Vivian says she doesn't know the difference between the credits and deductions. John took a guess, said, isn't one taking off from how much you do owe and one reduces your income? And you just explained all that. And then Christina asked, my teenagers don't count? I think because on your slide where it says children under 13. So what about for the folks who have 15, 16, and 17-year-olds living with them? There is not a child and dependent care credit for them, is what it sounds like?
well, under 13. And so you want to like other things that so you get the household credit or the head of household, what's it called? Status. So there's other things you can get when you have children under, because really it's under 17. When we talk about child and dependent care credit, this is specifically if you're like, let's say I have a child in daycare or a dependent care, like, where there's a need, like they're not in actual school where, for example, I have, my kids are in like a private school, right? And I pay for that private school. That is not a deduction for us, but my child that is in like preschool, right, or daycare, then the money that I pay into that is a deductible or a credit. But when they're over 13, no.
Thank you.
And then I'm glad you guys you asked about it because I went into it anyway with the difference of deduction and credit. And the point you want to look at is like with credits, it gives you money back even if you don't owe. Okay. And then deduction, it just takes you to zero. So they won't give you any money back. They'll just say you don't owe us anything else, right? We'll take you down to zero, but there's no money after that. And then we also have the savers credit. Savers credit is like when you're doing like your retirement and things like that. There's a savers credit for low to moderate income households, right? And I think that credit, that credit is up to $1,000, right? And then usually if we're talking about filing jointly, married couples, it's always double that for the other person because there's two people. So that would be up to $2,000 for a married couple if you're doing a savers credit for this year. Okay. And then we also have, if you guys have kids in school, or when I say school, it's like college, let me know, because I think this is like one of the things that I had a question about my last class was the college credits, okay? Because there's two different ones. There's a lifetime learning credit. And this one is like over the lifetime of them going to school. This one doesn't usually expire. But this is like expenses that you pay or your child is paying into to go to this school, right? And the things that you want to look at though is like there's not like a room and board. It's not that, but what it took for them to actually take the class. Maybe they had to purchase books or supplies, or the curriculum for that class, those things. And a lot of people pay out of pocket as well. So if you have to, then you have the lifetime learning credit. We also have the American Opportunity Tax Credit. And this one is the one that is limited, right? You can't take it over if you go to school for 7 years, then you can't continue to take that one. That one is about up to $2,500. And so these are things when I say keep your receipts, document if you're paying into any of these school supplies. These are things you want to keep because it is a credit. And this is something that if the IRS did down the line a couple of years, just want to know or challenge you on, then these are receipts that you want to keep. And this is during the first 4 years of, attending a college that is a qualified college, okay, or a secondary education. And so let's see. Now, you guys, changes this year. I laugh when I seen this because I said, okay, good. This is something that, is good. But I think for you guys, and what I wanted to point out is these are things that are affected either way because of the inflation, right? So even with the income tax brackets, they're going to be higher for us, like adjusted so that it's not unfair, right? They're not taxing us if we're not making a lot of money, right? And things are going up higher. The standard deduction increase, like I just kind of told you guys, with the standard deduction, it's $15,000 right now for single. It is $30,000 right now for married filing jointly, so it's about double. And then it's $2,200 or $22,500 for our head of household, who, maybe you're taking care of your kids or someone else in the household that can jump you up to that rate. So, you guys, if you are taking care of a family member, then, that is something, and you're covering more than half of the expenses of your household, then you qualify to do head of household. And so even some of those things are really important to note. Also, the tax brackets is also going to be beneficial. There's 7 tax brackets. And let me know, do you guys know what tax brackets you guys fit in? Or are you like, I don't know, I just pay the taxes? That's important to know. Because as I said before, it's always the goal to get you to a lesser tax bracket. So if you're a high income earner making 32%, you're taxed on 32% for my single filers out there, then the goal is always to say, how can we get you to 24? That's a huge jump, but how can we do it? And it's important for you guys I like to point out is when we talk about tax bracket, you're jumping into each tax bracket. So like not all of the money is going to be taxed at this one level. So the first 10%, so we have $11,925, right? That first $11,925 is going to be taxed at 10%. Okay. And then we go to the 12% tax bracket. So from 11,000 to 48,000, we're taxed at 12%. So we're consistently jumping into different tax brackets and paying different tax rates. But as you know, when you start to make more income, then a lot of that higher income is taxed at the higher rate. Does that make sense, you guys? Let me know if you're following along.
So you've got some comments in the chat. Let's see. Vivian says you were asking about if people knew what brackets they're in, and she says no. And she's also saying she's not sure if she can do anything about it. And Christina, I agree with you. She asked, why does it have to be so complicated?
I know. It's very, you guys, it's very complicated. Me as a professional, that is why, and things are always changing. So we have to stay on top of everything. And it's not an easy system to comprehend. I wish I had an answer of why it was so complex. But I will say what helps is just doing things like this, staying at least in the know. You don't have to know all of the things because it's so much. The tax code is like 6,000 pages long. And so it's just important to know like what works for your situation. So when we talk about tax brackets, as I explained, you're jumping into different levels, right? And I get a lot of people who maybe they got a raise from their job and they're like, yes, I'm finally hitting the maybe $100,000 mark, right? Maybe they were making 50,000, 30,000. And they're hitting different tax brackets going from 10% on the first 11,000. Then they, from 11,000 to 48,000, they're going to 12%. And they're just jumping. So there's like $1,200 they'll tax you. Then they'll tax you, or 500 from the 10%. Then they'll tax you another 600 from the 12%. Then they'll go to the 22% and tax you, so on and so forth. I get clients who, when they have a raise, they go, well, why do I have to pay so much taxes? And I say, I'm so sorry. I mean, it's a blessing and a curse because you make more money. So that's good because you bring more money in. But now you have to pay more because you're sitting in a higher bracket. And so what happens is you want to start seeing what credits are new this year. Are there any credits are rolling out? Or maybe, this is what a home does help a little bit, right? Because you are building wealth. You have your home, you're settled in. And even though you're paying a mortgage, some of that will still be used as a deduction on your tax return. So for the people who are looking to purchase a home or homeowner, someone who already has a home, this is something that you can look for to say, well, this at least will drop me into a lower tax bracket. Okay. So these are some other tax credit or changes that I wanted to make you guys aware of. And so we have the retirement contribution. So if you want to contribute, that usually goes up each year. All of these usually go up due to inflation. So you have that you can kind of like look, I'm not going to say look forward to, but like, you can contribute more because I think last year was 22,000 and 500. So now it's 23,500, right? And so as individuals who are over 50 and over, because you're kind of catching up to your retirement, that is 7,500 additional dollars on top of the 23. Okay. And then I wanted to let you guys know what the 1099. So I know we had this big thing happen and there's been some changes up and down with 1099s. Okay. So if you're doing anything online, maybe you're doing like Cash App or something, they're going to send you a 1099. At first it was $600. When you get $600, you have to report that. And it became a whole thing. If you guys have any 1099 work, let me know in the chat. Are you doing like any side things where that required you to do to get a 1099? Okay. Because this one will go up. This is just basically a third-party transaction. Things like Venmo, Cash App. They're reporting this to the IRS. And they're also reporting it to you so that you can report it to the IRS. So that's why I say, to answer someone's question in the beginning, if you report a wrong number, right? Maybe it was a typo because you asked what the red flag was. This is important, right? If you do not report what was on the 1099K, and the IRS gets it, they're looking at you like, okay, they're reporting and you missed something here. So that's also a red flag. The 1099 threshold this year is 5,000 for 2025. So it went up, you guys. 5,000 is good when it comes to this because, otherwise that's a $4,400 difference. At first, they were really being sticklers about you make $600 or more, we're sending this and you need to do all this extra stuff. Now it's 5,000. So that's a good thing that is happening for that. And then, yeah, we have, those are kind of like some of those changes that I feel like is good. Nisi, is there anything in the chat?
Yes. So Vivian had a question saying, so my random Venmos are taxed. And I want to jump into that too. Like if I'm out to lunch with friends or something and we have a shared check, we'll use Venmo or something like that. Mm-hmm. So now all those little transactions are taxed as income.
Well, and that was I love that you guys asked that question because this was the fight that was happening with the IRS. And this was where confusion started to come is, well, these are little things that we're doing. Maybe it's already money that was already taxed that I already was taxed on. I just sent it to pay for a bill or whatever it could have been. What's important is the business ones. And yes, if it's over a certain threshold, you still may receive like an information report. What we're talking about, like, it's important to when I tell business owners or somebody with a side hustle, they have Cash App for businesses now. So this is kind of like the ones that you want to focus on. if you are doing like receiving money in for a service that you're doing, or maybe you just did something on the side really quick for people, create the business one and separate it from it. Because if you're sending money to a friend or a family member, I would also, in that, there's a description box there where you guys can put in like, this was for food, this was for whatever the gift was, right? It wasn't necessarily like tax for good and services, then you'll be okay. But this is for people who are technically like running side hustles and businesses. You want to have that clear distinction of like separating it so that you can distinctly say this was for my personal side, not for like a side hustle or a business. Does that make sense?
It does. Thank you.
Okay. Yeah, because the business ones are taxable, guys. Keep that in mind. Okay. Now, we talk about common mistakes, you guys. This is something I was asked in the beginning. Filing statuses. Okay. This one gets overlooked also because like there's people who are single who should be filing single, not head of household. Okay. There are people who I've seen filed who were married filing single status and head of household status. That's a big no-no. There's a status for that, and that status is married filing separately and married filing jointly. Okay. If, you know, and I hear a lot of people, they don't want to combine or whatever the case may be, but just keep in mind, usually if someone's filing separately, like married filing separately, it's for a reason, right? There's a really a reason for that, because usually if you're filing this way, you're not gonna, the IRS really doesn't like this filing status, I say. So they take the credits and options away from you. So at that point, you actually don't get any benefit from married filing separately, other than you just feel that you cannot be in the married filings together, married filing jointly status. So I would pay attention to the filing status for sure. You guys, that's very important. Again, reporting your income incorrectly, understating the income, like missing certain forms in the tax return, not putting the correct form. Some common mistakes is, I've seen it a lot, you guys, people missing the not putting in the right social, and it's not on purpose, like not the full social, but it's like maybe a number was transposed when you were doing your tax return. That's a common one. And then also, you know, people using, maybe like I've seen this happen when there's two parents and they're separated, like they're not together, and one is trying to claim the child, and another one is trying to claim that same child. That one becomes a hard one, and that will cause like a lot with the IRS and a lot of headache on the back end. So those are some things that I would avoid, and some common mistakes that I would like make sure beforehand, like what are you doing, like that communication process of like, are you going to do this? Am I going to do this? And what does that look like? And that also you know, by doing that, that child also should be living with the main person more than half of the year. That person should be, you know, taking care of them more than anybody else. So those things still play into effect, but maybe you guys are, you know, maybe not you guys, but maybe in the situation, there's a half and half, you know? So in those situations, those are that's something I would recommend you kind of pay attention to. It's really important.
So it's funny you mentioned that about kids. I was going through a divorce a number of years ago, and the ex, it was a big battle over who was claiming our daughters. just because I had all the custody, he wanted all the money, and
Yeah.
it was a fight for sure. And then in the chat, Christina asked why are joint separated such a difference in tax amounts?
Well,
I'm guessing
yeah.
she's asking about married filing jointly versus married filing separately.
Yeah, that's a good question. That is simply because essentially when you're filing with the filing status of married, the whole thing is for you to file together. When you get a bigger deduction, there's two people, so you're the bracket that you're in. We all know that's probably the ideal bracket to be in because you get a better deduction than others. But when you're filing separate, they just don't that the IRS doesn't encourage that. They don't encourage it. So because they don't encourage it, you actually do not get the same credits. You don't qualify for a lot of the same credits that you would qualify if you filed together or as another status, single head of household. They just take those, unfortunately, privileges away from you. And that's why I said at that point, it has to be a specific reason why you're filing this way. And to give you like some insight, let's say, for example, you have a spouse who's just not responsible, maybe, or they owe a lot of money already. And you're like, I honestly do not want to be in this, this space where I have to get where you just have to be combined with that level of owing other individuals. Maybe there's like, what is it called? Child support or other things. And you're like, well, that has nothing to do with me, even though we're together. And believe me or not, some people feel this way and it happens. So at that point, you're like, I'd rather just keep it separate because either way, it's still the benefit of you having it separate outweighs the credits and deductions. So some people actually still take the separate filing status because they just don't want the other financial burden that the other spouse is bringing on. And so that is something that I would say is like something that you have to just kind of consider. And at that point, I would talk to a professional. That's when I would tell you guys to talk to a professional because you want to see what the benefit is if it outweighs you going married filing together or separately. But ultimately, it's discouraged upon the IRS. They don't want you to take that status.
Thanks.
Okay. Now, this is the part where it's what do you, and I probably have a couple of minutes. I'm going to try to like get through this fairly quickly. Time has been flying, but when should you use a tax professional? Okay. When should I be doing my own tax return? Simple, you guys. As things start to get more complex, then, when I get people coming in, maybe they're a simple W-2 and maybe they do have a home, right? I said, okay, perfect. You guys should file if it's easy on the software and it's more affordable, always try. But as it becomes more complex or you feel you're missing out on deductions and maybe you got a side hustle or a business now, or maybe you just have more forms, or you have sold some stock, or maybe you have started contributing to different investments, then at that point, I always say talk to a professional because the software doesn't always lead you to know what the right inputs are, or, because it does guide you to an extent. But there's just workarounds that some professionals like we would do. And there's certain credits that we would help you with that we already know is available versus you not really fully understanding what all of the available deductions or credits in. And we talk about not just credits, you guys, deductions. Okay. And how to actually put those in. So as your situation gets more complicated, that's when I say seek a professional. And also, before we go, please let me know, because I'll have Nisi tell me out loud, how many people are doing their own tax returns? So the deadlines that are coming up, you guys, April 15th. This is the tax deadline for individual returns. We're coming up on business pretty soon on the 15th of March. And so then after that, that would be April 15th for individuals. And if you're receiving refunds or things like that, at this 3-year mark, the cutoff, remember I said you have up to 3 years to file your prior 3-year tax return. So if that third year is coming up, this is the last year you can receive that refund. We have estimated tax coming up as well for those who are self-employed or you have a side hustle. There's quarterly taxes. So quarterly taxes are coming up on the 16th. And then if by April, you're like, I don't want to file yet, I'm going to file an extension. Like a lot of people I know do this, especially if you owe money. They will file an extension. That extension comes up August or October 15th. So that is like something that I kind of wanted to point out to you guys. So if you did not file your 22 tax return and you feel like you're getting a refund, file that by April 15th. Okay. These are some steps. I call it a pyramid. This is what you can do to kind of get ready. And you guys do this throughout the year, right? It's not just a April or a January, February thing. Of course, you have to wait on your 1099s and W-2s, but things that you have during the year, hold on to those, file those. Look at whatever method you're going to use. If you're buying a home or you're like, I'm getting into more investments this year, I'm going to start looking at professionals and interviewing different people and seeing what I need to do ahead of time so I'm not feeling stressed out during this season. And then understand what your deductions are. You know, if you're getting into something new, see if it's a deductible. And then always, know that, towards the end of this, you have the option to file electronically or by mail. Of course, by mail is very slow. If you're filing by mail and you receive a refund, it does take longer to get. The IRS is backed up. So, they're always pretty much backed up, but that is something to kind of keep in mind. And, I just encourage you guys to just be proactive, right? When things change throughout the year, I encourage y'all to look at it like, what would this do on the tax side? Not be scared about it, but just be curious. If you're selling a home this year, right? Don't sell it and then think about the tax side. Before you sell it, you think about the tax side so that you can now understand what your options are. Talk to a professional so that you're not thrown off about capital gains and how much you're taxed and what you can do instead. Okay. And so I do thank you guys for being here today and then, going with us and sticking through the technical difficulties we had and asking your questions. And this is kind of the end of this presentation, but, I'm still going to be here to answer some of you guys' questions. So if you want to stick through and stay on the call, then I can chat with you guys a little bit.
Thank you, Karina, so much. So a couple questions in the chat. One, Vivian, she asked, does she need to file extensions for both state and federal?
Yes. Okay. If you're going to file an extension, you should be able to, when you're filing on a tax return, if you're filing an extension, it should ask you if you're going to file extension with both.
Okay. And John, he's got a serious question. I didn't file for a couple years, so I'm not sure how to fix it.
Okay. Yeah, you want to get on that, John, because the penalty is higher for not filing than it is for not paying, believe it or not. The IRS wants to see what you have going on, unfortunately. So it's important to just get it done sooner than later. Usually what's going to happen is you're going to end up having your last tax return filed first, right? So wherever the year that you didn't, that stopped, maybe you filed, your last filing date was 2022 or 21, then you would now do 2022 and then work your way up into what's current so that you can be current. But I would encourage you to get that done sooner than later.
Thank you. So that is the end of our questions. And so, Karina, I want to thank you so much. I know that the tech issues we're rough today. In a perfect world right now, everybody would be seeing Karina's beautiful face right here next to me. But we can hear her voice and appreciate so much all of the wonderful information. And we will make this recording available on demand for those who couldn't join us today. We are going to have additional workshops coming up with Karina, with Cortez, with Kay Patrice Williams, on a whole variety of topics. You can find all of those, as well as sign up for our to get one-on-one housing counseling sessions for free at our website at solanohomeassist.com. And I just want to say thank you again to Solano County. They're the ones who are funding this and trying to make sure that everybody has a place to go when they're struggling. And I want to thank Karina so incredibly much. I learned a lot. I still have more questions myself, but it's giving me, it's showing me the things that I need to do to get ready, because I have not filed my taxes. So thank you so much. If anybody has any last questions they want to throw in the chat, awesome. If not, you can always get a hold of us. You can email us direct at hello@solanohomeassist.com or go to our website. There's lots of ways to get involved. So once again, Karina, any final thoughts?
I would just say, you guys, like I said, be proactive. If you really, to me, when you're also looking at who you want to work with as professionals, make sure that it's a professional who is interested in kind of giving you information, not just doing the work, right? Because like you guys have questions, those are things you want to say, okay, can you explain this properly? How can I understand in a simple way? And then like, what are my options moving forward? Because you at least want to know, like, going forward, what you should be doing. That is you being proactive and not reactive. Because I'm very straightforward when it comes to that. Be proactive. Okay, you guys, that way you're ahead of the game and you're prepared. So I really am so happy that you guys decided to take control and ask questions, be curious, because this helps you put your best foot forward and prepare and really be prepared in the way that you can take control of your own situation. So thank you guys for being here.
Thank you so much, Karina. I greatly appreciate you. And thank you for joining Solano Home Assist today. And we look forward to seeing you at a future workshop. As we like to say, get home, stay home. Thank you. Have a good one.